Why did this legendary investor make a $1 billion investment in a railroad? That's what we're going to dig into over the next few minutes. Bill Ackman. You've probably heard of him. Some people don't like him, but one thing's for sure, he's beat the market. His fund, Pershing Square, has returned a little over 16% annualized since inception. That's better than the S&P 500's return of 9.7% over that time. This is why I try to pay attention when he does something. And in his most recent 13F filing, I noticed that he increased his stake in the railroad Canadian Pacific from $205 million to over $1 billion from the second to the third quarter in 2022. I thought he must love the company to increase his stake by 5x in just 3 months. So in this video, we're going to dive into Canadian Pacific to see why it was worth Bill betting $1 billion on it. But first, a little education on the railroad industry. Railroads are an oligopoly, meaning it's a market with a small number of firms, none of which can keep the others from having significant influence. There's a high cost of entry, and in the US, there's already a dense rail network, so new competitors aren't likely. Goods of all kinds are transported via rail, but they are broken into two categories: bulk goods and merchandise. Bulk refers to commodity cargo that is transported unpackaged in large quantities. Merchandise goods, on the other hand, are packaged ready for their consumer. The fastest growing major rail traffic segment over the past 25 years has been intermodal. Intermodal is the movement of shipping containers and truck trailers via rail. Rail transport is cost effective, fuel efficient, and growing in demand. Freight rail is the most fuel efficient way for companies to transport goods, and it emits less greenhouse gases than all other modes of transportation. Demand for rail is expected to grow 30% by 2040, which doesn't make this a meme stock that's going to double over the next 5 weeks or 5 days, but it'll be steady growth over the long term. In addition to all that, railroads are typically inflation resistant because they can recoup rising operating costs that are caused by inflation by raising freight rates, fuel surcharges, and other fees. Businesses who need to get their product to market have little choice but to pay up. This is referred to as Warren Buffett as pricing power, and it's a great moat for the railroad industry. Okay, now that we have the rundown on railroads, let's go on to Canadian Pacific. Ackman notes that CP is a high-quality, inflationary protected business led by a best-in-class management team. He adds that with an improving volume and pricing outlook, combined with the upcoming transformational acquisition of KCS, we believe the future is bright. So where will Canadian Pacific's growth come from? First, it will come from Kansas City Southern's customers, plus new customers that will switch over to Canadian Pacific because of their ability to connect Mexico, the US, and Canada. The acquisition will give shippers access to unrivaled speed and service. Secondly, growth will come from the rail industry's growth as a whole. Rail transport is both cheaper over the long distances than trucking and is more environmentally friendly as it produces far less greenhouse gases. As customers increasingly look to reduce their carbon footprint and the rail industry enhances its customer service levels, the rail industry's share of freight transport should grow over the coming years. In addition, with the Ukraine-Russia war, U.S. onshore energy production is expected to increase, which CP will benefit from because of the increased demand for onshore energy transportation. Currently, the company makes a good chunk of its revenue from energy transportation, and that will most likely grow as a result of this. So where does Canadian Pacific stand today? Last quarter it did $2.4 billion in revenue, up 21% from a year ago. Its operating ratio was 59.8%, meaning the company's managers spent 59.8% of the sales. This operating ratio has been a big focus for management and has improved dramatically since Q4 of 2012, when it was almost 75% on $1.5 billion of revenue. This means the company's management has become more efficient while increasing revenue. The company threw off about $2.7 billion in cash flow this past year, which will be needed to pay down its debt. The company took on about $8.8 billion in debt to fund the cash portion of the KCS acquisition. It's not all bad though. As we could see on Morningstar, they have an interest coverage of 7.3, so they shouldn't have a problem servicing their debt. Speaking of the acquisition, CP should be able to take over operations in the next 1 to 2 months as it awaits final approval from the U.S. Surface Transportation Board, but Canadian Pacific has not been able to take over operations yet. Canadian Pacific says that there should be about $1 billion of synergies when the deal closes, which is a mixture of new revenue and cost savings. Okay, so there's our overview of Canadian Pacific, and I can see why Bill Ackman likes it. The company has good management, is in an inflation-protected industry with incredible pricing power, and is poised to grow in the long term because of its acquisition and the rail industry's growth as a whole. Thanks for watching, and let me know what you think in the comments.